In this video, we are going to be creating a tier list for all the different YieldMax ETF options. Now, I'm personally going to be ranking all the YieldMax ETFs from A to F, A being the best and F being the worst in my opinion, and I'll of course explain my reasoning for doing so. But before we start building out this tier list, let's head over to the YieldMax ETF website and look at all the ETFs that we're going to be talking about today, explain how these ETFs work just to get everyone on the same page. So on the YieldMax ETF website, there's multiple different ETFs that have pretty much for the most part the same strategy, but that do have exposure to different ETFs or stocks. OARK, for example, tracks the RK ETF, TSLY of course uses Tesla, APLY uses Apple, NVDY uses Nvidia. There's even some newer ones like AMZY, which is Amazon of course, FBY, which is Facebook, GOOY, which is Google, and NFLY, which is Netflix. Now they do also have some newer ETFs that just came out as of recently, and they also have some even newer ones that they're coming out with soon. So they're really pumping out these ETFs for different stocks, and there's even some rumors I've been hearing through the community that they might even be coming out with more option ETFs to track different ETFs, or even an option ETF to track all these option ETFs. So you could say it's getting pretty crazy in the YieldMax ETF world. But this right here is Coney. This is for Coinbase stock. MSFO. This is for Microsoft, of course. Then we have DISO for Disney and XOMO for ExxonMobil. So later on towards the end of the video, I will be going into the literature for TSLY specifically to go over exactly how this fund and how pretty much all these YieldMax ETFs work. So stay tuned until the end of the video so you can learn exactly all that entails. So before we start the tier list, one last thing I want to go over. Looking at all the distribution rates for all these different YieldMax ETFs, this is exactly why these ETFs are so popular in my humble opinion. It's because receiving an almost 50% distribution rate on an ETF is just outlandish. And even with some of the smaller ones like Netflix, Google, and Facebook being around 17 or 25%, either way, these distribution rates are massive because of the cover call strategy that we'll go over later on in this video. When the cover call strategy is executed properly, and if these individual stocks or ETFs comply within the cover call constraints, there can be massive distributions and massive premium to be paid, which is what we've seen so far. So now heading over to the tier list, stacking up all these different ETFs from the best to worst, I want to make one thing very clear. When it comes to cover call ETFs, or really any ETF in general, you're really going to want to keep one thing in mind. This is a very important aspect. You're going to want to ask yourself, what is within the holdings of this ETF, and is this something that I want exposure to? Now, for example, TSLY, this obviously uses Tesla, and a lot of the good and bad movements that TSLY has is going to mimic the price movement when it comes to Tesla. Now, just like that, NFLY is going to do the same for Netflix. So when it comes to buying into ETFs, especially these YieldMax ETFs, if you're not interested in the underlying stock or ETF at all, that's definitely going to be a red flag and maybe something you should consider before you want to invest into it. Even if the distribution rate is very, very favorable, it's definitely something to consider. So let's start off with one of my favorite in this entire list is going to be TSLY, which is the YieldMax Tesla option ETF. Now, TSLY is in the top position for me personally because I do in fact like the underlying stock that it's tracking, Tesla. I am very bullish on Tesla long term, so even though it's a covered call ETF, and even if Tesla moves up like crazy in share price, it doesn't necessarily mean that this TSLY ETF is going to move up like crazy, because of course covered call ETFs do have a capped upside. But either way, I think Tesla for the most part is going to be giving out some massive premiums like it has historically, and for the most part, at least from here into the foreseeable future, I'm very bullish on Tesla, so that reaches number 1 at the A spot for me. Number 2 in the A spot is going to be APLY, or the YieldMax Apple ETF. Now, APLY does have a much lower distribution rate at a 14.01% distribution rate. So comparing it to Tesla, you're getting like less than half the dividend, of course. And that's of course due to the fact that Apple has much less volatility. So the premiums are not necessarily going to be jacked up as high as they are with TSLY, but I love Apple as an underlying stock, and I definitely think that Apple is going to be trading sideways or upward from here for at least the foreseeable future. So I'm definitely very bullish on Apple and APLY, and that's exactly why I actually hold both of these in my portfolio as of right now. Now, the next YieldMax ETF that's going to be in the A territory for me is NVDY, or the Nvidia one. Now, Nvidia is a stock that I don't actually hold right now. I held it a while ago, but I sold it off when I made a little bit of money on it, and I wish I wouldn't have. Nvidia is an absolute beast of a stock and a company, and just like Tesla, it offers massive premiums for investors. So NVDY, or the YieldMax Nvidia option ETF, is definitely going to have some volatility and could definitely see some possible price decay, but I think the distribution should be pretty high for Nvidia from here on out. Now, just to get it out of the way, let's add OARK, the ARK-K fund, right in the F territory for me. Now, I bought some ARK-K a while back, and I actually was down pretty bad on it and have not looked back ever since. I'm not a big fan of any of the ARK ETFs, and that one is definitely going to be landing in the F position for me. Now, another one that's going to be in the F position for me is going to be Disney. Now, Disney, for one, is not necessarily going to offer massive premiums as far as the options go, and for the most part, I'm just very bearish on Disney from here on out. Disney is definitely going to be an F for me. Netflix is going to be a D for me. I'm really not that big of a fan of Netflix stock altogether. I did own some Netflix a while back. Netflix does have some decent premium when it comes to options, so the distribution rate might be decent, but I personally definitely think that Netflix has more downside potential from here, so Netflix is going to go in the D as far as a place for me. Now, Amazon is going to go in a B territory for me. Amazon pretty much almost makes it in the A territory, but just because of the fact that I'm probably less bullish on Amazon compared to something like Tesla, Apple, or Nvidia, Amazon's going to be right behind, but I also am looking closely at AMZY, and I wouldn't be surprised if AMZY makes it into my portfolio at some time here. Now, I'm going to add FBY, or the Facebook YieldMax ETF, into the D category because, again, I'm not all that bullish on Facebook. I do think that Facebook could trend down from here, and honestly, just compared to the other options, it doesn't really make sense to me why I would buy FBY over a lot of these other ones. Next, Coinbase. Coinbase is a hard one because I do think Coinbase is going to have a pretty good distribution, but as far as the overall platform and all it has to offer and the upside potential from here, I think I'm going to put Coinbase at a C. Now, I put it at a C because I do think that the distribution rate is going to be pretty massive, or at least it could be because of the option premium. But Coinbase overall as a company, as a platform, and as a stock, I'm not necessarily super bullish on it right now, so Coinbase is going to be in a C. Next, GOLY, or Google. This one is going to be in a B territory pretty much for all the same exact reasons I gave Amazon for landing in the B territory. It's definitely not my favorite compared to these three up here, but I think GOOY does possibly have a future spot in my portfolio. Next, Microsoft, or the MSFO. Now, this one's really tough because I think it could probably land in either an A, B, or C for different reasons. Now, for one, the premiums aren't necessarily going to be massive because Microsoft's premiums as far as options just aren't really all that great all the time. But if I were to land Microsoft somewhere, I think it would once again be in the B territory. It might land a spot in my portfolio in the future. I definitely have my eyes on it. I've talked about that in the past. But as of right now, once again, I'd rather just buy into these because of the reasons I talked about earlier. And last but not least, we have ExxonMobil's XOMO. Now, I personally don't understand much of a reason to buy into something like this. I personally don't really watch ExxonMobil stock all that closely. I did own it a while back, but I don't necessarily want to own something that's so tied to oil. So for that reason, I would probably add XOMO either in the F category or the D category. For this case, let's just put it in the D category. So there we have it. As far as A's go, we have TSLY, we have APLY and Nvidia, and we have NVDY. As far as B goes, we have AMZY, GOOY, and the Microsoft ETF. Then C, we have Coinbase. D, we have Netflix, Facebook, and ExxonMobil. And then F, we have OARK and DISO. So now that we went over the tier list and you know exactly which YieldMax ETFs I like the most and which ones I don't like much at all, just like I promised, let's dig a little bit deeper into the TSLY YieldMax literature and explain exactly how this specific ETF works and generally speaking, how the rest of the YieldMax ETFs work. So now we get to the good part inside the TSLY prospectus. It says YieldMax TSLY Option Income Strategy ETF Fund Summary. The investment objective is the fund's primary investment objective is to seek current income. The fund's secondary investment objective is to seek exposure to the share price of the common stock of Tesla, subject to a limit on potential investment gains. Next, it talks about the management fees, and because this is an actively managed fund, the fee is actually very, very high, at almost an entire percent, 0.99 to be exact. It then says principal investment strategies. The fund is an actively managed exchange-traded fund that seeks current income while maintaining the opportunity for exposure to share price, i.e. the price returns of the common stock of Tesla. Now, TSLA, subject to a limit on potential investment gains. The fund will seek to employ its investment strategy as it relates to TSLA, regardless of whether there are periods of adverse market, economic, or other conditions, and will not seek to take temporary defensive positions during such periods as further described below. So the principal investment strategy is basically saying that they have a strategy, they're going to stick to it, and they're not all of a sudden going to switch up the strategy if there are, for example, adverse market events. So that's pretty clear and straightforward and definitely good to understand, just to know that there's not going to be a potential extra hedge placed on the ETF, etc. It then says, as further described below, the fund uses a synthetic covered call strategy to provide income and exposure to the share price returns of TSLA, subject to a limit on potential investment gains as a result of the nature of option strategy it employs. The fund's option contracts provide exposure to share price of TSLA, Tesla, also current income from option premiums, and a limit on the fund's participation in gains, if any, on the share price of Tesla. So that might be one of the first red flags that I don't think a lot of investors necessarily understand, that the fund actually uses a synthetic cover call strategy. So if you don't happen to be aware of what a typical cover call strategy is, a cover call involves sellers offering buyers a call option at a set price and expiration date on a security that the seller owns. Now, just like I said a second ago, a cover call normally involves selling options on securities that the seller owns. And just like we saw a second ago in the case of TSLY, they don't actually own TSLA. They use a synthetic cover call strategy to provide income and exposure. But reading on a little bit further, an investment in the fund is not an investment into Tesla. The fund strategy will cap its potential gains if Tesla's share price increases in value. Now that's normal in any cover call situation. If the price of the security does move up in price by a lot, most likely the shares will get called away, so it's normal that there's going to be a cap on the potential gains of whatever cover call you're really selling. The fund strategy is subject to all potential losses if Tesla's shares decrease in value, which may not be offset by the income received by the fund. That's also pretty straightforward, basically saying that even if the fund does receive premiums, which are going to be pretty big because Tesla does have some pretty good volatility, if Tesla for whatever reason does decrease in share price by quite a bit, it doesn't necessarily mean that the premiums are going to make up the losses if Tesla decreases in price by quite a bit. It then says once again, the fund does not invest directly in Tesla, which again, in most cover call strategies, you are buying into shares of a stock or an ETF and then selling options on that. But in this case, the fund does not even own Tesla. Fund shareholders are not entitled to Tesla dividends or anything of the sorts because this fund does not own Tesla. So next, this is very important. This is getting a little bit deeper into the option use and of course the synthetic cover call strategy. It says as part of the fund's synthetic cover call strategy, the fund will purchase and sell a combination of standardized exchange traded, flexible, e-exchange or flex call and put option contracts that are based on the value of the price returns of Tesla. So basically what this fund is doing is they're utilizing calls and puts and synthetically creating a situation where they're receiving the potential upside of a situation of selling cover calls on Tesla without actually having to do so. It then says in general, an option contract gives the purchaser of the contract the right to purchase for a call option or sell for a put option the underlying assets, like shares of Tesla, at a specified price, the strike price. The seller of an option contract obligates the holder to deliver the shares for a sold or short call, or buy shares for a sold or short put for the underlying assets at a specific price, again known as the strike price. Now, option contracts must be exercised or traded to close within a specified time frame, which is known as the expiration date. And of course, you can look a little bit deeper into this fund's calendar of expiration dates, etc. It then says the fund's option contracts are based on the value of Tesla, which gives the fund the right or obligation to receive or deliver shares of Tesla on the expiration date of the applicable option contract in exchange for a stated strike price, depending on whether the option contract is a call option, a put option, or whether the fund purchases or sells the option contract. So lastly, now looking into the synthetic cover call strategy, which a lot of you might have never even heard of such a thing as synthetic cover call strategy. For me personally, I sell cover calls throughout my portfolio, but I've never set up a synthetic cover call. So it says in seeking to achieve its investment objective, the fund will implement a synthetic cover call strategy using the standardized exchange traded and flex options described above. A traditional cover call strategy is an investment strategy where the fund sells a call option on an underlying security that it owns, which again in this case, they do not own any Tesla. A synthetic cover call strategy is similar to a traditional cover call strategy in that the investor sells a call option that is based on the value of the underlying security. However, in a synthetic cover call strategy, the investor, the fund, does not own the underlying security, but rather seeks to synthetically replicate it 100% of the price movements of the underlying security through various investment instruments. Very interesting. It then says that the fund's synthetic cover call strategy consists of following 3 elements, each of which is described in greater detail below. Synthetic long exposure to Tesla, which allows the fund to seek to participate in changes up or down in the price of Tesla stock. Cover call writing, where Tesla call options are sold against the synthetic long portion of the strategy, which allows the fund to generate income. And lastly, U.S. Treasuries, which are used for collateral for the options and also generate income. It then says down below, there is no guarantee that the fund's investment strategy will be properly implemented, and an investor may lose some or all of their investment, which this sort of stood out to me as well. It then pretty much just goes through a bunch of legal jargon and talks about the risks of investing into ETFs, talks about Tesla, etc., etc. So now that we went through my personal tier list and we went over some of the literature for the YieldMax ETFs, I want to hear from you guys down below what you think of my tier list. And I definitely want you to comment if you think I'm completely off in any of my placings. Comment down below. If you enjoyed this video, make sure to please drop a like on it and subscribe for more future content like this. Thanks as always for stopping by, and if you are interested in investing, make sure to check out these recent videos I posted right here.